You lost your last trade because your analysis was wrong. That is what you have been told. That is what every trading forum will tell you. It is not true. You lost your last trade because you were reading a chart built to show you patterns while the real market was moving liquidity. Two different games. You were only playing one of them. Here is the number nobody wants to sit with. Roughly 90% of retail traders lose money over any extended period. Not because they lack discipline. Not because they skipped a course. Because they are trained, from day one, to look at price the wrong way. You were taught to draw trend lines. You were taught to wait for RSI to cross 30. You were taught that a double top means the market is about to reverse. All of that feels like structure. All of that feels like control. But ask yourself something. Who sets the price you are reacting to? It is not retail traders. Retail volume is a rounding error next to institutional and interbank flow. Banks, hedge funds, and liquidity providers move the kind of size that actually pushes a market. And size that large cannot simply appear at the best price and hope for fills. It needs the other side of the trade. It needs counterparties. It needs, in plain terms, liquidity. That word gets thrown around so casually that its meaning has been diluted. Liquidity is not a buzzword. It is the pool of resting orders sitting above old highs and below old lows. Every retail stop loss placed just beyond a safe level is not safe. It is inventory. When enough of that inventory clusters in one place, it becomes a magnet for exactly the kind of move that clears it out in seconds. Think about where you place your stop loss. Be honest. You probably place it a few pips below the most recent swing low. That is not a random habit. It is the single most predictable behavior in retail trading, repeated by millions of accounts, every single day, on every single pair. When a level becomes that predictable, it stops being protection. It becomes a target. This is where the psychological trap begins. You see price approach your stop. Your heart rate climbs. You watch it wick through, hit your stop, and reverse instantly in the direction you originally expected. You didn't misread the trade. You were the trade. Your capital became the fuel that let a larger position enter at a better average price. Let's slow down and look at the mechanics, because vague frustration will not fix this. Price does not move in a straight line toward fair value. It moves in a search pattern. Algorithmic execution models, the kind used by institutional desks, are built to minimize slippage on massive orders. One method for doing that is called iceberg execution, where a large order is broken into smaller pieces and fed into the market gradually, often triggered by pockets of resting liquidity being absorbed first. This is not speculation. It is documented market microstructure. The concept traces back to work on optimal execution strategies, most notably the framework built by Almgren and Chris in the early 2000s, which modeled how large trades should be sliced over time to balance market impact against execution risk. That framework, in some form, underlies how modern algorithmic execution engines behave. When you understand that even the biggest players are managing impact, not chasing single candles, price action stops looking random and starts looking like a process. So what does that process usually look like on your chart? A rally that keeps stalling at the same resistance. A slow grind lower that keeps sweeping the lows of the last 3 sessions. A sharp spike that reverses within minutes, leaving behind what traders call a stop hunt, though the more accurate term inside institutional order flow discussions is a liquidity sweep. The label matters less than what it represents. Price is being sent to a zone where resting orders exist, those orders are absorbed, and then price is free to move toward the actual objective. Here is the part that should change how you look at every setup from now on. A fair value gap, that imbalance you have probably heard mentioned dozens of times, is not some mystical institutional footprint. It is simply an area on the chart where price moves so quickly in one direction that it left a gap between candles, a zone where buying and selling did not fully exchange hands. When price returns to that zone later, it is not magic. It is inefficiency being corrected, because algorithmic models are frequently built to seek fair value before continuing a directional move. Same with an order block. Strip away the mystique and it is a specific candle, or cluster of candles, right before a strong directional move, where a large player likely built a position. Price often returns to that origin point to allow the remainder of that position to be filled before continuing. None of this requires belief in conspiracy. It requires understanding that big orders cannot fill all at once without moving the market against themselves. Now here is where most traders sabotage themselves even after learning all of this. Knowledge without structure is just anxiety with better vocabulary. You can know exactly what a liquidity sweep looks like and still lose your account, because you have no risk architecture protecting you from being wrong. And you will be wrong. Every trader is wrong a meaningful percentage of the time. The traders who survive are not the ones who are right more often. They are the ones who are mathematically positioned to survive being wrong. This is where the numbers actually matter. Consider a strategy with only a 40% win rate. That sounds unimpressive. Most beginners would abandon it immediately. But if your average winning trade returns twice what your average losing trade costs you, that 40% win rate produces a positive expectancy. The math is simple. Multiply your win rate by your average win, subtract your loss rate multiplied by your average loss. A 40% win rate at a 2-to-1 reward to risk ratio nets out positive over a large enough sample. Meanwhile, a trader with a 70% win rate and a 1-to-3 reward to risk ratio, risking 3 times what they stand to gain, is mathematically destined to bleed out over time. Why does this matter here? Because most retail traders obsess over win rate and completely ignore expectancy. They want to feel right more than they want to be profitable. That emotional preference is exactly what keeps accounts small and blown accounts common. Do you actually know your expectancy on your last 20 trades? Most traders cannot answer that question, and that alone tells you why the outcome keeps repeating. Risk architecture is not complicated, but it is unforgiving of shortcuts. Position sizing based on a fixed percentage of account equity, typically somewhere around 1% per trade for most retail-sized accounts, is not conservative for the sake of being cautious. It is conservative because of a concept called risk of ruin. If you risk 10% per trade, a string of 6 consecutive losses, which is statistically unremarkable, erases more than half your account. Recovering from a 50% drawdown requires a 100% gain just to get back to even. That asymmetry is the real enemy, not any single losing trade. There is a historical example worth sitting with. Long-term capital management, a hedge fund staffed by Nobel laureates in economics, collapsed in 1998 not because their models were wrong about market direction, but because their leverage turned a manageable drawdown into a systemic collapse. Highly intelligent people with sophisticated models still failed because position sizing and leverage were mismanaged relative to volatility. If that can happen at that level, what does it tell you about a retail account running 5 times that leverage on a strategy with no defined risk per trade? So bring this back to the chart in front of you right now. Stop asking whether a pattern looks bullish or bearish. Start asking where the resting liquidity actually sits. Where would a large position need price to travel before it makes sense to enter size? Where are retail stops clustering? And is price being drawn toward that cluster before the real move begins? This single shift in the question you ask changes almost everything about how you read a session. It also changes how you place your own orders. If your stop loss sits exactly where everyone else's does, you are not being disciplined. You are being predictable. Placing your stop with a small buffer beyond an obvious level, or structuring your entry around a liquidity sweep instead of anticipating one, removes you from the pool of inventory that price is designed to seek out. None of this guarantees you will win your next trade. Nothing does. What it does is align you with how price is actually delivered instead of how it appears to move on a surface-level chart. The traders who last are not smarter than everyone else. They stopped reacting to candles and started reading intent. They stopped measuring success by how often they are right and started measuring it by whether their math survives being wrong. Tomorrow, when you open your charts, do not ask what the pattern is telling you. Ask where the liquidity is sitting, and ask who benefits from it being taken. You did not lose your last trade because your analysis was wrong. You lost it because you were reading the chart the market wanted you to read, instead of the one it was actually built on.